All right, I'm live. Move this out of the way. A little coffee. All right, everybody. I was going to try to not go on today, but it's a gorgeous day outside. So I went out for a bit. Just saw an article. All right, I guess I'm live, and I'm just going to start, even though I don't see anybody here. I know you guys must be out enjoying the weather as well. There's not a lot to talk about on Railtown particularly, but what I want to start with is this book, The Great Taking, which you can find online. I was unable to get it on Amazon, but I think you can buy it online. But you can download it too. It's The Great Taking by David Rogers Webb. And I guess one of the reasons, there's two reasons that I want. It was written in 2023, but he updates it. I like his dedication for Dad. If I had to dedicate what I'm doing now, I'd say for Dad. Anyway, he also says in memory of David. But here's the table of contents, and there's a prologue which I'm going to skip. We can get to it another time. I'm just going to read the introduction and the first 3 chapters, and then we can do other parts of it later. Prologue's very long, that's why I'm skipping it. But we'll come back to it on a later presentation. So one reason I'm doing this is a friend of mine got a call from somebody who thinks, I guess, I'm speaking ill or something. I'm not speaking ill about anybody, but I do have a complete different opinion on this idea of being able to catch a short squeeze and chasing stocks that are trying to squeeze. And I just don't think it's feasible without a very specific set of circumstances. So that's one reason I'm going to try to teach you this and teach myself this. The second thing is, if we do have success in our Railtown position, I don't want you to feel like it's hot money. I don't want you to think that, hey, I made 10x, I made 20x, I better get out. This isn't a hot, now it doesn't mean that the story or the parameters of the story of the investment couldn't change, and we have to be aware of that. But as it is now, there's no reason to sell if you make 10, 20, 30x in your portfolio. There's much more ahead, in my judgment. And I guess I'll add a third thing. It looks like we're going to be at war in the Middle East, potentially in Europe, and perhaps in Venezuela. And the thing that all three of those potential fights have in common is, as far as I understand, and I could be wrong, there exists very little by way of Western banking loans made out to Russians, Iranians, or Venezuelans. So you have the world's richest country in resources, probably $100 trillion worth of resources, which is largely untouched by Western loans. In fact, it's been the policy since approximately Hillary Clinton and Valerie Nuland and the whole neocon aspect to sanction Russia out of the Western banking system. So there's $100 trillion in assets, collateral. But if you can cause regime change and then break it into various parts, break it all up, or the empire, our empire, the British Empire, whatever it is, the banking system, that's London, New York, Geneva, possibly Tokyo's in on it, but the Western banking system can claim that collateral. Iran has, I forget, I've got the book behind me, but I think Iran, by stated reserves, which I don't trust, by the way, I don't trust any of the reserves that are stated. But if you go with the collateral idea, it's in the interest of the banking system to have overstated reserves because it's more collateral. But I think Iran would be in the top 6, maybe 7 countries in terms of oil reserves in the world. I can only think that Venezuela, Canada, and Saudi Arabia, maybe, by stated reserves, are greater than Iran's. Maybe the United States pops in there, and maybe Iraq. But anyway, it's right up there. So that's collateral. If we can do regime change, as they call it there. And then Venezuela, obviously, it's a different kind of different kind of oil. All of our refineries in Texas are, not all of them, but a lot of them are set up to process Venezuelan oil. And I've heard, I don't know where to give you a reference point, that Venezuelan oil is particularly good for diesel fuel. When we do these horizontal drilling and frack, it might be our refineries, or it might be the grade of oil, but it's not as I understand it, it doesn't make a lot of fuel for trucking and other industries. So that's my third thing, is maybe why all these wars are coming up is all about banks needing collateral. So let's start. This is The Great Taking. The Great Taking by David Rogers Webb. David Rogers Webb. The Great Taking. So we'll start at the introduction, which is not the very beginning of his book. I skipped the prologue. His first sentence, introduction. What is this book about? It's about the taking of collateral. There it is. It's about the taking of collateral. All of it. The end game of this globally synchronous, I guess how you say that, debt accumulate, I wouldn't use that word, but this globally synchronous debt accumulation super cycle. This is being executed by long-planned, intelligent design, the audacity and scope of which is difficult for the mind to encompass. Included are all financial assets, all money on deposit at banks, all stocks and bonds, and hence all underlying property of all public corporations, including all inventories, plant and equipment, land, mineral deposits, inventions, and intellectual property. Privately owned, personal, and real property financed with any amount of debt will similarly be taken, as will the assets of privately owned businesses which have been financed with debt. If even partially successful, this will be the greatest conquest and subjugation in world history. We are now living within a hybrid war conducted almost entirely by deception, and thus designed to achieve war aims with little energy input. It is a war of conquest, directed not against other nation states, but against all of humanity. Private, closely held control of all central banks, and hence of all money creation, has allowed a very few people to control all political parties, governments, the intelligence agencies, and their myriad front organizations, the armed forces, the police, the major corporations, and of course the media. These very few people are the prime movers. Their plans are executed over decades. Their control is opaque. When George Soros said to me, quote, "You don't know what they can do," unquote, it was these people to whom he referred. Now, to be absolutely clear, it is these very few people who are hidden from you, who are behind this war against humanity. You may never know who they are. The people you are allowed to see are hired face men and face women. They are expendable. One might seek comfort in thinking that this must be crazy. Nothing like this has ever happened before, but it has. The precedent for the intent, design, and horrific execution of such a plan can be found by examining the early 20th century, the period of the Great Wars and the Great Depression. The proclaimed, quote unquote, Great Reset, now in progress, however, includes major innovations, which will allow unprecedented concentration of wealth and of power over humanity through deprivation. How might it come to pass that you will own nothing, as so boldly predicted by the World Economic Forum? It certainly is not about the personal convenience of renting. With the collapse of each financial bubble and the ensuing financial crisis, a story is rolled out which should by now be familiar to you. It goes like this: all of us are at fault. We just wanted too much, and we were living beyond our means. And now, our collective greed has caused this terrible global crisis. The quote-unquote authorities, the quote-unquote regulators, had struggled mightily to protect us from our own quote-unquote animal spirits. Their great and elaborate efforts having been demonstrated through decades of work. Despite their good intentions, however, they failed and can't be blamed, paren, or prosecuted, unparen, for that. After all, we are all to blame. In any case, let's look forward. The financial system must be restarted so that we can provide credit to you again, create jobs, and get the economy growing, whatever it takes. This time, what it will take is all of your property, or what you thought was your property. Here is your central bank digital currency deposited on your smartphone so that you can buy milk. Noblesse oblige. Money is an extremely efficient control system. People order themselves upon money incentives, and thus difficult, dangerous, and energy-intensive overt physical control need not be employed broadly. But the money control system breaks down at the end of a monetary, quote-unquote, supercycle with collapse in the velocity of money, which will be referred here on in as either velocity or VOM. This is a multi-decade process. Velocity is the number of times that a unit of currency is spent to buy goods and services in a period of time. This is measured by comparing the value of all goods and services produced in a period of time. That's also called gross domestic product, or GDP. With the value of all cash and deposits, which can be used nearly as easily as cash, money supply. So let me read that sentence again. Velocity is the number of times that a unit of currency is spent to buy goods and services in a period of time. This is measured by comparing the value of all goods and services produced in a period of time, GDP, with the value of all cash and deposits, which can be used nearly as easily as cash, money supply. Velocity equals GDP over money supply. Velocity. Thus, velocity times money supply equals GDP. Lower velocity results in lower GDP. Milton Friedman was an economist noted for the study of monetary history. In his book, A Monetary History of the United States, 1867 to 1960, co-authored with Anna Schwartz, we find the following observation, quote, "We know enough to demonstrate rather conclusively that velocity of money must have declined sharply from 1880 to World War I." Unquote. Collapse in velocity of money is exactly what was unfolding from the 19th century and leading up to the Great War. Within a few years, the Russian, Austro-Hungarian, and Ottoman empires ceased to exist, as did the Qing dynasty. The German economy was destroyed. Then followed the Great Depression, the Second World War, and the slow collapse of the British Empire. No populations were unscathed. There were no winners. Or were there? While there was widespread deprivation, selected banking interests took the collateral of the thousands of banks which were forced to close. As well as of a great many people and businesses, large and small, the indebted. In the United States, gold held by the public was confiscated, but most importantly, closely held secretive private control of central banks and money creation was maintained, as was the aforementioned control over society's key institutions, including political parties, governments, intelligence agents, armed forces, police, major corporations, and the media. The heirs to this control position have known for many decades that such a collapse in velocity of money would come again. They have been preparing. For them, it is an absolute imperative to remain in control through the collapse and the quote-unquote Great Reset. Otherwise, they risk being discovered, investigated, and prosecuted. They are not doing it for us. There is no noble purpose. We are now living within a replay of this monetary phenomenon, i.e., a profound decline in velocity of money, which began when velocity peaked in 1997. This was coincident with onset of a major global financial crisis known as the Asian financial crisis. And it was followed within a few years by the dot-com bubble and bust. Throughout this period, I was managing long, short equity hedge funds, and I developed the insight that the Federal Reserve was influencing the direction of financial markets. This was considered conspiracy theory even by my partners. At the same time, it was done through open market operations conducted by the New York Fed using repurchase agreements, on Treasury securities. I began systematically following the rate of growth. The rhythm is wrong in that sentence, and I apologize. I began systemically following the rate of growth in M3, the broadest measure of money at the time, which is no longer published. I studied what was unfolding incrementally, and I saw that in individual weeks, new money created was more than 1% of annual US GDP. This was when it first occurred to me that the Fed was getting less bang for the buck, in that GDP was not responding to money creation. This meant that the velocity of money was inverting, and that money growth was now much higher than any GDP growth. The money being created was not going into the real economy, but it was driving a financial bubble with no relationship to the underlying economic activity. I understood this, not with hindsight, but in near real time. If I could know it, Alan Greenspan and the people he worked for knew it too. So why did they do it? If something doesn't make sense, it's necessary to change one's perspective and aim for a larger understanding. Crises do not occur by accident. They are induced intentionally and used to consolidate power and to put in place provisions for measures that will be used later. By the fourth quarter of 1999, when the dot-com bubble was reaching extremes, I saw that money supply was being increased at more than a 40% annual rate. I understood then that the velocity of money was collapsing. Such a collapse occurs when the economy is not growing despite very high rates of money creation. Please observe the extremely important chart in figure 1.1, which was prepared by Hosington Management. For once, one can see a true underlying determinant of the sweep of history. I'll show you the chart. But I'm not sure I didn't study it, so I'm not sure I'm going to be able to. It's entitled The American Business Cycle. Time is on the horizontal axis. On the vertical axis is, I guess, the business cycle. And the peak was the recent peak was 1997, right here. That must be the GDP. It doesn't say it. It says, okay, figure 1.1, annual velocity of money from 1900 to 2021. So it's actually showing you the velocity of money, which reached its peak in 1997. Continuing, profound decline in velocity of money led to the financial panic of 1907, which was used to justify the establishment of the Federal Reserve System. The Federal Reserve Act was passed by Congress in the quiet days before Christmas 1913. Archduke Ferdinand was assassinated 6 months later. Following a brief recovery in velocity of money during the Great War, it collapsed further, leading up to the closure of banks and the confiscation of gold in 1933. Velocity of money recovered somewhat into the Second World War and then collapsed to a low in 1946, unprecedented until now. Here's the chart again. Here's the 1946 low, and here's 2023's low. It's below that velocity of money. VOM has now contracted to a lower level than at any point during the Great Depression and World Wars. Once the ability to produce growth by printing money has been exhausted, creating more money will not help. It is pushing on a string. The phenomenon is irreversible. And so, perhaps the announcement of the quote-unquote Great Reset has been motivated not by quote-unquote global warming or by profound insights into a quote-unquote fourth industrial revolution, but rather by certain knowledge of the collapse of this fundamental monetary phenomenon, the implications of which extend far beyond economics. Something has been planned for us, but not for the reasons you have been given. How might we come to know something about the intention of the planners? Perhaps by examining their preparations. So we'll go on to chapter 2. Which has a quote by Sun Tzu, "All warfare is based on deception." The title of the chapter is Dematerialization. There are now no property rights to securities held in book entry form in any jurisdiction globally. I'll reread the first sentence of chapter 2. There are now no property rights to securities held in book entry form in any jurisdiction globally. In the grand scheme, to confiscate all collateral, dematerialization of securities was the essential first step. The planning and efforts began over half a century ago. That there was some great strategic purpose behind dematerialization is evidenced by the fact that the CIA was assigned the mission. The project leader was William Bill Dentzer Jr., a career CIA operative. By his admission in his own written memoir, he started his career working to establish anti-communist student organizations in Europe with the backing of the CIA. The CIA had arranged his draft deferment. He was then specifically assigned to the CIA and worked there openly for 5 years. Subsequently, he was transferred, quote unquote transferred, from the CIA to the task force, which created the Agency for International Development, AID. He became special assistant to the first head of AID, and thereafter special assistant to the U.S. coordinator of the Alliance for Progress, which was active in Latin America. He was then appointed executive secretary of the Clay Committee, which lobbied for congressional appropriations for AID. After 3 years as director of AID in Peru, he was named deputy U.S. ambassador to the Organization of American States. He states in his memoir, quote, "Given events in the United States in the late 1960s, including the assassinations of Martin Luther King and Robert Kennedy, my interests had begun to shift from the international to the domestic front," unquote. Then, strangely, even though he had no background in any aspect of banking or finance, he was appointed New York State Superintendent of Banks by Nelson Rockefeller. This came after his nomination to the newly formed New York State Council of Economic Advisors by its chairman, former head of the World Bank, Eugene Black. Interestingly, Black's father had been chairman of the Federal Reserve in 1933. Within 2 years of assuming his position as New York State Bank Superintendent, Dentzer was named chairman and CEO of the newly formed Depository Trust Corporation, DTC, a post he held for the next 22 years, i.e., through the entire process of dematerialization. By the late 1960s, something called the Banking and Securities Industry Committee, BASIC, B-A-S-I-C, had been formed to find a solution to the quote-unquote paperwork crisis. It seemed the burdens of handling physical stock certificates had suddenly become too great. So much so that the New York Stock Exchange had suspended trading some days. Quote unquote lawmakers then urged the government to step into the process. The basic BASIC report recommended changing from processing physical stock certificates to quote-unquote book entry, transfers of ownership via computerized entries in a trust company that would hold the underlying certificates, quote-unquote, immobilized. Let me read that sentence one more time, and I will point out to you, this is the first time I'm reading this book too. That sentence, to repeat, is the Banking and Securities Industry Committee report recommended changing from processing physical stock certificates to quote-unquote book entry transfers of ownership via computerized entries in a trust company that would hold the underlying certificates, quote-unquote, immobilized. This trust company would develop the necessary computer and other systems. I happened to meet with network engineers of DTC 40 years ago in my first job out of school. Was this quote-unquote paperwork crisis manufactured in order to provide an imperative for dematerialization? Consider that DTC did not begin operations until 1973. And that no significant degree of dematerialization was achieved for many years. However, somehow, during this intervening period, stock exchanges continued to function in spite of escalating trade volumes without the elimination of certificates. Especially with the aid of computerization, it could be done and was done. DTC eventually became the model for the Central Securities Depository, CSD, and Central Clearing Counterparty, CCP, the purposes of which will be explained later. All right, that was chapter 2. And now we'll go on to chapter 3. And then it'll be a little longer, but then we can discuss it and we can talk about other things. And leave the rest of the book maybe for tomorrow or Monday. My feeling is you're not going to want to listen to this book during trading hours, so maybe I'll do it tomorrow. So chapter 3 is called Security Entitlement. It's right out in front. Never attempt to win by force that which can be won by deception. Niccolo Machiavelli. The greatest subjugation in world history will have been made possible by the invention of a construct, a subterfuge, a lie. The quote-unquote security entitlement. Since their beginnings more than 4 centuries ago, tradable financial instruments were recognized under law everywhere as personal property. Perhaps that is why they were called securities, unparent. It may come as a shock to you that this is no longer the case. In order to convey to you what has been done, let me start with an analogy. Let's say that you have purchased an automobile for cash. Having no debt against the vehicle, you believe you now own it outright. Despite that, the auto dealer has been allowed by a newly invented legal concept to treat your car as his asset and to use it as collateral to borrow money for his own purposes. Now, the auto dealer has become bankrupt, and your vehicle, along with all the others sold by the dealer, are seized by certain secured creditors of the dealership, with no judicial review being necessary. As legal certainty was previously established that they have absolute power to take your car in the event of the bankruptcy of the dealer. Now, to be clear, I am not talking about your car. I am illustrating the horror and the simplicity of the lie. You are led to believe that you own something, but someone else secretly controls it as collateral. And they have now established legal certainty that they have absolute power to take it immediately in the event of insolvency. And not your insolvency, but insolvency of the people who secretly gave them your property as collateral. It doesn't seem possible. But this is exactly what has been done with all tradable financial instruments globally. The proof of this is absolutely irrefutable. This is wired to go now. Essentially, all securities, quote unquote, owned by the public in custodial accounts, pension plans, and investment funds are now encumbered as collateral underpinning the derivatives complex, which is so large, an order of magnitude greater than the entire global economy, that there is not enough of anything in the world to back it. The illusion of collateral backing is facilitated by a daisy chain of hypothecation and rehypothecation in which the same underlying client collateral is reused many times over by a series of secured creditors. And so it is these creditors who understand this system, who have demanded even more access to client assets as collateral. It is now assured that in the implosion of the quote unquote, the everything bubble, collateral will be swept up on a vast scale. I'll read that again because I stumbled. It is now assured that in the implosion of the everything bubble, collateral will be swept up on a vast scale. The plumbing to do this is in place. Legal certainty has been established that the collateral can be taken immediately and without judicial review by entities described in court documents as, quote unquote, the protected class. Even sophisticated professional investors who were assured that their securities are, quote unquote, segregated will not be protected. An enormous amount of sophisticated planning and implementation was sustained over decades with the purpose of subverting property rights in just this way. It began in the United States by amending the Uniform Commercial Code, UCC, in all 50 states. While this required many years of effort, it could be done quietly without an act of Congress. These are the key facts. Bullet. Ownership of securities as property has been replaced with a new legal concept of a quote unquote security entitlement, which is a contractual claim assuring a very weak position if the account provider becomes insolvent. Bullet. All securities are held in unsegregated, pooled form. Securities used as collateral and those restricted from such use are held in the same pool. Bullet. All account holders, including those who have prohibited use of their securities as collateral, must, by law, receive only a pro rata share of residual assets. Bullet. Revindication, i.e., the taking back of one's own securities in the event of insolvency, is absolutely prohibited. Bullet. Account providers may legally borrow pooled securities to collateralize proprietary trading and financing. Bullet. Safe harbor, quote unquote, safe harbor, assures secured creditors priority claim to pooled securities ahead of account holders. Bullet. The absolute priority claim of secured creditors to pooled client securities has been upheld by the courts. Account providers are legally empowered to, quote unquote, borrow pooled securities without restriction. This is called, quote unquote, self-help. As you will see, the objective is to utilize all securities as collateral. I assure you, this is not conjecture. You would be greatly mistaken in dismissing this as a quote-unquote conspiracy theory, which is a common reaction to so much unpleasantness. It is possible to really know about this. The documentation is absolutely irrefutable. In April of 2004, the European Commission Internal Markets and Services Director General proposed, quote, the setting up of a group of legal experts as a specific exercise intended to address problems of legal uncertainty identified in the context of considering the way forward for clearing and settlement in the European Union, unquote. This became the Legal Certainty Group. Legal uncertainty sounds like a bad thing, and legal certainty sounds like a good thing. However, the objective was merely to make it legally certain that secured creditors would be empowered to immediately take client assets in a failure of a custodian. In March of 2006, the Deputy General Counsel for the Federal Reserve Bank of New York provided a detailed response to a questionnaire prepared by the Legal Certainty Group, which was looking to the Fed to tell them exactly how to do it. The following are excerpts from that response, which is attached in full in the appendix. Question from the EU. In respect of what legal system are the following answers given? Answer, New York Fed. This response confines itself to U.S. commercial law, primarily Article 8 and parts of Article 9 of the Uniform Commercial Code. The subject matter of Article 8 is investment securities, and the subject of Article 9 is secured transactions. Article 8 and Article 9 have been adopted throughout the United States. Question, EU. Where securities are held in pooled form, for example, a collective securities position rather than segregated individual positions per person, does the investor have rights attaching to particular securities in the pool? Answer, New York Fed. No. The security entitlement holder has a pro rata share of the interest in the financial asset held by its securities intermediary. This is true even if the investor positions are quote unquote segregated. Question, EU. Is the investor protected against the insolvency of an intermediary? And if so, how? Answer, New York Fed. An investor is always vulnerable to a securities intermediary that does not itself have interests in a financial asset sufficient to cover all of the securities entitlements that it has created in that financial asset. If the secured creditor has control over the financial asset, it will have priority over entitlement holders. If the securities intermediary is a clearing corporation, the claims of its creditors have priority over the claims of entitlement holders. Question, EU. What rules protect a transferee acting in good faith? Answer, New York Fed. Article 8 protects a purchaser of a financial asset against claims of an entitlement holder to a property interest in that financial asset by limiting the entitlement holder's ability to enforce that claim. Essentially, unless the purchaser was involved in wrongdoing of the securities intermediary, an entitlement holder will be precluded from raising a claim against it. Question, EU. How are shortfalls, i.e. the intermediary's position with an upper tier intermediary is less than the aggregate recorded position of the intermediary's account holders? How are shortfalls handled in practice? Answer, New York Fed. The only rule in such instances is that the security entitlement holders simply share pro rata in the interests held by the security intermediary. In actual fact, shortfalls occur frequently due to fails and for other reasons, but are of no general consequence. Except in the case of the securities intermediary's insolvency. Question, European Union. Does the treatment of shortfalls differ according to whether there is 1, no fault on the part of the intermediary, 2, if fault, fraud, or 4, if fault, negligence, or similar breach of duty? Answer, New York Fed. In terms of the interest that the entitlement holders have in the financial assets credited to its securities account, regardless of fault, fraud, negligence of the securities intermediary, under Article 8, the entitlement holder has only a pro rata share in the securities intermediary's interest in the financial asset in question. Continuing the chapter. That's how it works directly from the horse's mouth, i.e. the most authoritative source possible, lawyers working for the Fed. Further exposure of the purpose of the invention of the securities entitlement can be found in a discussion paper concerning, quote, legislation on legal certainty of securities holding and dispositions, unquote, prepared by the European Commission's Directorate General Internal Market and Services in 2012. Quote, where securities are concerned, the standard has always been that a custodian has to hold sufficient securities in order to meet all its clients' claim. In most EU jurisdictions, such a standard is guaranteed by giving investors ownership rights towards securities. Some markets, however, treat securities like money. Wow. the US and Canada based their law on the concept that investors do not own securities, but they own securities entitlements against their account providers instead. The advantage of this concept is the potential increase in the amount of assets available for collateral. The advantage of this concept is the potential increase in the amount of assets available as collateral, but critics view it as a threat to stability of the system because the assets concerned are based on the same underlying resource. Concern has been voiced by market participants, regulators, central banks, and international institutions about potential collateral shortages. There is pressure to broaden the range of securities eligible as collateral. As a result of the demand for collateral, securities are increasingly regarded by market participants as a funding tool. These trends reinforce the market trends to treat securities like money. With significant implications for ownership. The risk of unauthorized use of its clients' assets is increased by the employment of omnibus account structures. Omnibus accounts pool assets so that individual securities cannot be identified against specific investors. This works well until a bankruptcy occurs. If the account provider defaults, a client with a mere contractual claim becomes an unsecured creditor, meaning the client's assets are, as a rule, tied in the insolvency estate, and it is obliged to line up with all the other unsecured creditors to receive its assets back. Reuse of security interest collateral carries greater risk to the financial system because multiple counterparties may compete for the same collateral in default. So-called priority contests, and also unquote. Clearly, the European Union Directorate General Internal Market and Services fully knew the above in 2012. In the next global financial panic, what are the chances that there will be much of anything remaining in these pools of securities after the secured creditors have helped themselves? There will be a game of musical chairs. When the music stops, you will not have a seat. It is designed to work that way. It is time to ask, cui bono? Who benefits? It is certainly not the citizens who have lost their property rights, who have been betrayed in this deception by their own governments. The reason given for this legislation on legal certainty is, quote, demand for collateral, unquote, by quote unquote market participants, They are not referring to you and me, the public. Quote unquote, market participants is a euphemism for the powerful creditors who control governments. They have worked for many years to establish their legal certainty worldwide. That's the end of chapter 3, and that's where I'm going to stop reading, and we can discuss. I'll look at your questions. And that's pretty powerful. I don't want to, I'm not talking about myself at all, but this is the first time I read this. I did read that, many times, that 3-paragraph summary to you referencing this work. But what's amazing, he says it right in here. I've been saying that for what, 2 years? 3 years? Just struggling with my own definition, struggling with what I see. I've been telling you that these investment bankers, with all their wisdom, they just imitating commercial bankers. I always stumble over what to call it, but they're creating a fractional reserve securities deposit system or a fractional reserve securities holding system, just like the fractional reserve banking system. And here it said right here, it's the first time I read it. They treat securities like money. But the thing is, securities aren't money. All right, so what I take from this, before I start looking at your points, I take from this that it's ever important that we create our own financial independence and that we act as our own central banks, and that hopefully we establish positions in gold and silver, platinum, and other any real assets, farms, orchids, anything, before a great financial collapse comes. I don't know, and no one can know, if there's a huge correction, which I've been projecting after the S&P goes to 8,500, the Dow to 65,000, NASDAQ to 30,000, Russell to 4,000, and gold to 5,000, although now it looks like it's going to beat that, and silver to 120. I think there's going to be a 95% correction in the markets. That may be as it's compared to gold prices, I don't know, but I think there's going to be a severe correction, and we'll see if that's all she wrote. I don't think it will be. I think the banks will be given credit, and the central banks will be given belief one more time, as they just, I don't know, print 50 to 100 trillion dollars of money but with governments to back up and to restart the system. And this comes to mind, if you know that this is coming and you're going to need to have 50 to 100 trillion dollars to print, and you want your financial system to survive, and you don't have any collateral left, go after the Soviet Union. Go after Iran. Go after Venezuela. Anyway, that's what's been. I love this book. I wish I had read it before, but in a way, I'm glad I didn't, because it forced me to think through things on my own and come to conclusions that made me feel a little crazy, but they were my own conclusions. And now I've read some of it right there, and it's pretty powerful. All right. The only other thing that I think is important to talk about is that when you guys listen to the theory that you can invest in a stock, and some sort of machination between whales and trucks out in front of the SEC, which I've gone down to, or walking the halls of Congress, or suing, you're not going to cause a short squeeze. It's all legal. It's all legal. I have given certain situations where it looks like short squeezes can occur, and it's basically the longs, the ones trying to create the squeeze, have to break the law. They have to bribe a trading desk, pay millions of dollars to somebody to turn on algorithmic computer trading with a bunch of spoofing and all the security violations that the shorts do, to try to fool the shorts computers into thinking there's real demand for the stock. And then they have to hire promoters to get you to buy the stock, and then hope it becomes a meme. But that also needs some event, like they found a new vein of rare earths in the middle of one of their properties, or they just invented something, the new iPhone, and everybody wants it. Some surprise like that, combined with cheating on the part, breaking the law on the part of longs, and then getting retail in, and it spreads like wildfire, tricks the sell side computers, and you can have a short duration short squeeze. But it has nothing to do, in my judgment, with brokerage firms buying in fails to deliver. It has everything to do with perhaps the brokerage firms, the prime broker, and the short side, not really panicking, but they manage their losses, and they'll absorb huge losses rather than let a loss become undefinable and infinite. So you can get those rare short squeezes if all those things line up. But if you're chasing these stories based on the really weak argument that there's a gigantic short position, 250 million shares, and there's only 40 million in the float, and the stock's going to go to 3,000, I think all of us have to adjust our thinking and realize that there's nobody going to rescue us. There's no moral crusader out there coming to enforce what's right or what's wrong. This great taking is in progress. All right, let me go to your questions. I don't know who this guy is. What do you want to know about GTII? If you want an update on GTII, I would follow Ham Short Killer. It's his stock. It was his idea and something that he suggested, and it's something he's close to. The other source of information you can get on GTII is from Richard Hoffman, not legal advice. And he's got pretty good legal understanding of what happened there. But I don't know what you just put a question mark there. I personally think it's the height of idiocy to buy GTII right now when it's in this expert market. I do not think there'll be a short squeeze in GTII. I think the shell is overly burdened with claims on ownership, percentage ownership, such that I don't even think the shell will be used by the current person/company of interest. So I could be wrong on that. But if that gentleman brings his company into GTII as a reverse merger, it's clear to me monies will be raised. There will be shares issued, and a majority of the ownership of that company will go to the newco's current holders. So GTII is worthless. It's worthless. There's nothing there. It's a write-off. If there is some sort of financial offering, it'll be in the context of newco. Read that, and you can make a new decision to invest. But many people sold GTII. If you still have it, maybe you can sell it, maybe you can't. It may be just something you write off, but it's worthless. We now know that Eric B says we now know that Railtown will present something December 17th. Well, I assume that I assume you're right, but we don't know what will go on at the annual meeting. But you're right. There'll be a discussion of something. It could be very narrow or it could be broad, but the agendas at annual meetings are not always overly expansive. But yeah, Eric, I'm going to try to go to it wherever it is. I'd like to go and see what's happening. Maybe there will be, maybe there'll be. I've gone to annual meetings, or I guess shareholder meetings, where there's dinner the night before, or some event where everybody gets to know each other. I look forward to that. You're right. The other point, Eric, I don't have it open in front of me, but it has a record date for shares. I don't want to be, I'll try to find it before the end of this call, but I want to say it was in November, but I could be wrong. Maybe it was the first week of December. Whatever the record date is to be able to attend that meeting, that would be an interesting date to watch, to the extent that investors want to go to that meeting. They got to buy their shares prior to that record date. Or I guess on it. I'm actually not clear if we're now at a T+0 or a T+1. And the record date used to take that into account. I don't know. I assume if you buy it by the record date, you have it. But let's see what it says. Well, we'll read that. Jeremy Bodel. Jeremy, your question is, I guess, or is it a statement? GTII and finger. I just gave my sense of finger. The best source of information on the story fundamentally is the guy that brought the idea to you, and that's Ham Short Killer. Follow him on Twitter, and you get updates there. If you want to know about the legal path that's going on with GTII, follow Richard Hoffman at Not Legal Advice. Finger. I mean, Jeremy, I don't know if you've been listening to me all year, but certainly since I started, could I use the word a friend of mine uses? Since I started hammering, or a better word might be yammering, on about Railtown, June 5th, I made a broad prediction that I thought finger could go to under $1.50 and maybe as low as $1.25. The stock was trading higher then. I think it was, five something, but maybe that happened a little bit earlier and it was 3, 4 something, whatever. But I made that very clear to everybody. In fact, I recall one investor asking me here, and I said I couldn't give specific advice, but I said strategically what I would do. I think she had 1,000 shares of Finger, and I really think it was over $5. I said you could sell that. You could buy 12,000 shares of Railtown. Well, here we are later. Railtown's gone up and down. If she had done that, she would have 12,000 shares of Railtown. Admittedly, it hasn't really done any, major move, but she essentially doubled her money, or 70-80%ed her money. But 12,000 times 45 cents, that's $5,400. Her 1,000 Finger right now is worth $1,500. So I think, Jeremy, that wasn't the only time I said it. I think my guidance on Finger, much to the chagrin of other people on the story, oddly, maybe it's because I don't own it anymore, and I wasn't in a position to participate. But oddly, I've called it almost exactly this year on Finger. I thought when Finger got down around $1.04, I said, this looks like an interesting trade. It might be worth doing. It could go to $2, $3, $4, $5, maybe even $6. And but I think you got to triple or better from here up. And sure enough, not because I did any work. Maybe it was the hard work of others. Maybe it was momentum. Maybe it was, I don't know, but it happened. The chart looked like that and the stock went to 5. I don't know if it got to 6. I can't remember. But I do know people were calling me and other people were suggesting and other people were buying calls. Jeremy, I said, don't buy them. Why don't you sell them against your position? Or if you did buy them, why don't you take your profit? And I also suggested selling the stock. So, Jeremy, I don't know if you're trying to, I may have misunderstood your point, but I think I've been, believe it or not, accurate on finger all year. So allow me to project what's ahead for finger. One of the things I said is they're going to have to raise money. Oh, only shorts say that. Well, they did raise a little bit before, and I think they're going to raise money now. And in fact, they filed to that effect, Jeremy. I would be surprised. It's an at the money raise from time to time. I'd be surprised if that's going to be a small raise. To the extent that people can get this audience and other audience to buy the stock up, the shorts, the Toad and the rest will sell it down, creating a pool of money so that when O'Flaherty Financial, whatever it's called, calls and says, hey, we got a deal, they'll say, well, we can give you 5 million or 10 million, but we wanted it at $1.25 with 1.5 or 2 warrant coverage, 2.5 even. So I think finger motion is a mistake to buy right now. I would not buy finger motion now. If you own it, it may seem late, but I think, again, I can't give you personal advice, but strategically, I would still sell it and buy Railtown and wait 31 days to reestablish a position should you so desire. But finger motion is going to raise money. And I think this time could be different, but it's every other time they've done it at a discount to the current price. And when it says at the money offering, it doesn't mean they're going to stay at this market price. That's not what it means. So I expect finger motion, unless the promotional guys can get the stock up so suckers buy the stock. I would expect that there is shorting going on, selling stock that doesn't exist, probably by the Toad. And once they get to 5 or 10 million of money, O'Flaherty will call them or vice versa, and they'll do a deal at $1.25 with 2 warrants coverage, something like that. It could be lower. I could be wrong. Maybe they run the stock up to $1.90 and they do the deal at $1.40. But that's what's coming, Jeremy. When that prospectus comes out, it won't be clear who did the buying. That's unfair. But there'll be other information in there, and you can read it and then decide whether you want to hold or buy finger. My final observation is I don't know why you're bringing it up. In comparison to Railtown, I think it's almost silly to own finger. Railtown trades at 45 cents. We know, I would say with a certainty of 99.999%, that the acquisition of AIP has occurred. We're just waiting for that final slip of paper to come in the mailbox, which could have happened last night. It didn't, though. But I would guess it'll be by Tuesday. I think the attorneys have a well-deserved break. You know, they do everything. They're super powered people. They can handle everything, and you know, they have to catch up on the family and the kids and take a break, spa, whatever. But they'll be back when office hours start. So I don't think they're working on the weekend. And my guess is they come back midday Monday. So I don't expect anything Monday. I would say Tuesday after hours, or maybe at midnight, is the soonest we'll see that. But once that comes through on Railtown, I think you're going to start to see buying in Railtown and other events. And I'm not going to go through them in this answer. We'll talk about them later. But I think Railtown, which currently trades at $60 million market cap, is equal to or better than its competition, all of whom trade over $1 billion in valuation, 1 billion. And in fact, I've shown two examples, and I've heard of one that I don't know the name, so it's third-party information. But I've shown two to everybody, and I'll do it again, and a third one where the similar revenue characteristics, which still have to be fleshed out, it gives a range of 1.1 billion in valuation all the way up to 12 billion in valuation. I've shown that Soundhound, which has almost an $8 billion valuation, which has next year targeted revenues of about, give or take, of 175 million, making zero money. Railtown could do that. And it's all about projection, by the way. It's all about projection. It's not about waiting until the revenue comes and then looking backwards and adding it up. By that time, the stock will be much higher. So anyway, those numbers, Jeremy, range from, depending on how many shares you assume are out, they range from $4 all the way up to $55 a share. And again, just to remind you, Jeremy, the revenues just have to be projected in a believable way in the hottest space, in the biggest market in the world, software development. And it's AI 2.0. Finger, now going to Finger, they've done 35 million in revenue basically each year for the last 3 years, to my memory, and they make no money. They're in a very low margin business. Top up minutes. They make no money. They have a high burn rate. And the stock is trading right now at 3 times revenue. A little bit more than that. A little bit more than that. Finger Motion has a higher market cap than Railtown. I believe it's trading at 105. It might be 95. I'm doing it by memory. But it's basically 3 times revenue. I don't think a top-up business should be trading any higher than 1 or 1.5 times revenue. So how can you explain that difference? I think the difference is the C2 contract valuable, and they have decided to take a slow approach to that for whatever reason. We may start seeing revenue this quarter or next quarter on that, and that could be interesting. But I don't think it's going to have exponential excitement and justify massive multiples, but it could increase revenue. So maybe 3 times revenue. there might be some justification there. The second area is Sapientus, the big data, and they've got the insurance companies and the cloud that they can sell access to. These have the potential to be quite large sources of revenue in the future, but to date they haven't. So I guess that if you're excited about big data, or if you're excited about the command and control contract, the stock's worth 3 times revenue. Not making any money. High burn rate. Always needing to raise money. And then the final variable is this concept of a stock squeeze, which I just, unless they cheat with and bribe, paid 3, 4, 5 million to a trading desk in Panama or Bahamas or some Bermuda, and then turn on all the computers and spark it, there's not going to be a short squeeze in finger motion. So I think your odds of success in finger motion at currently $1.50, let's say by the first quarter, you could have a stock that's trading at $1, or you could have a stock that maybe is trading at I don't know, $2 or $3. Is there a chance of a squeeze? Yeah, but it's got to be manipulated. It's not going to happen because the system is going to start buying in shares. Railtown in that time frame, by let's say the middle of the first quarter, it starts today at 45 cents, not $1.50. Like Fingers $1.50, I'm saying it could be somewhere between $1 and maybe $3 in the first quarter. And my probability would be under $2 in the first quarter. But as the story changes, I think Finger has a compelling longer term story. But between now and the first quarter with Railtown, Jeremy, from 45 cents, I'd say in the middle of the first quarter, you could just add a 0 to those numbers. Instead of Railtown, finger motion being $1 to $3, for Railtown, add a 0. I think by the end of the first quarter, Railtown is $10 to $30. So I don't see any risk to the downside in Railtown on a businesswoman's risk. Obviously, everything in the markets in these kind of stocks has variables that we can't control. But I think if you're seriously asking me for some reason that I've got to spend 20 minutes on GTII and Finger, if you own them and you can sell them, I'd buy Railtown Monday. That's me. You do what you want. But you're wasting your time, and you're wasting this audience's time on both stocks. But thank you, Jeremy, for your input. Hey, Donna, how are you? Donna says, hello, William, Eric B., and everyone. Giuseppe. Saturday, William, thanks for the deep dive into poolside yesterday. I caught up late. Danish economist, is that with cheese or not? Danish economist Henrik Zeberg has been calling for a melt-up, then a deep drawdown for as long as you. Okay. The other guy out there that that's been saying it for a long time is David Hunter. And, you know, there's some others. I also recently read 2 books on the Weimar Republic. Not so recently, I'd say it was last year. It probably could do with a refresher on them. But it's also, Giuseppe, something that I've been looking out for at least a decade, probably more like 2 decades, because that's what happens at the end of the secular bull market. So it's very interesting. Henrique Zeberg. I'll try to look him up. Let me write him down. Did I tell you, by the way? Did I tell you, Giuseppe, where we are on Railtown? I didn't tell you, did I? I didn't tell you. I probably missed some Friday because I lost some messages when the computer went down. That's where we are on Railtown. 14,293,000 shares. 14 million shares. Bravo to all of you. His book is, I'll get that book, Giuseppe. I'll get that book. The Monetary House of Cards. If you recommend it, I'll get it. When the going gets tough, the tough buy Railtown. Good for you, Julius. When the going gets tough, buy Railtown. I would just suggest when the going gets tough, the tough buy Railtown. I love it. I love it, Julius. Hey, Red Pepper, Ronnie. How was Halloween? I'm pleasantly surprised you're on today. Well, I avoided, I left, went over, tried to get something to eat and watch the baseball. I was purposely avoiding trick or treat. But when I came back, the couple that lives upstate, they were out front with trick or treat. They said nobody came by, but it was, you know, everybody was in good spirits, and I'd say it was a nice Halloween. I didn't enjoy the Blue Jays losing. I didn't. And to quote the pitcher for the Dodgers, Snell, he said after the Blue Jays won, he said they got lucky. Well, I think the Dodgers got really lucky last night with that goofball call out in outfield and other screw-ups. So, all right, there, Eric, thank you. It is a November record date. So that's important. November, let's Google it right now. I just don't trust what the rules are. What does a record date mean as to when to purchase a security? It used to be you had to own that security on that date. So it was the settlement date. So if it used to be 5 days. So if there were a record date on the 10th, you had to buy the stock on the ex dividend date or the X date, which was November 5th, but I don't know what it is right now. A record date is the date by which you must be registered as a shareholder to receive dividends or vote. To receive a dividend, you must purchase the stock before the ex-dividend date, see, which is typically one business day before the record date. All right, so we're still on T+1, so it's one business day. So if you buy it one day before, this gives the trade enough time to settle for you to be on the company's books. Okay, so it is one. I thought it was T plus. So the X day, yeah, it says T+1. All right, I thought it might be T+0. So anyway, if the record date is on the 10th, X date apparently is the 9th. So you got to buy it by the 9th, or you got to do same day settlement on the 10th. And it'd be interesting, Eric. That might, I mean, it might have an effect on the demand for the stock. That's next Monday, not this Monday. That's 2 Mondays from now. That's interesting. That's interesting. Thank you, Eric. Malcolm Barrett. Which web are we currently on? Well, we could go through some Jimmy Webb songs, but that book I was quoting from is The Great Taking by David Rogers Webb. That's who it was. Justin Babish, do you know what the RT vote in December is going to be for? I don't know if there will be a vote. But let's read it again. I think I can show it to you. Let me see if I can get it. I may not have taken a picture of it, but let me see if I did. No, I didn't. So let me just, I know how I can get it. I think I know how I can get it. Oh, what happened? Sorry, it's going to be a different microphone. The power almost went out, and my power line, I had to check the plug and check. I don't know what's wrong, but I disconnected the microphone for now, and it seems to be charging. So now it's a different microphone. So I don't know if it's worse or the same. I'm sure it's not better. Let me show you a couple of things. One, I don't know why I should show it to you, but I will. I'll show you one of them. This is from Patient Swings right here, Railtown. DD time. Take a bit of time this weekend to review this post below. Great AI education piece. And then tell me our little gem isn't worth the wait. Perfect window for the company to strike, in my opinion. That's for you, William. Well, who the heck's opinion is it going to be? Otherwise, anyway, in Patient Swing's opinion. So look up Ty Kim. Why AI is underhyped and isn't in such a bubble yet. I'll try to find that story. But anyway, Justin, this is the notice, and it's very hard for me to read, but I'll leave it up there and I'll look it up on my phone. So it says, notice of meeting and record dates. Meeting type, annual general meeting. So it doesn't mean there has to be anything to vote on. Typically at an annual meeting, you vote on the board or new board members, or you extend the CEO's term. But there's no indication here what it's going to be a vote about. The issuer is sending proxy materials to NOBOs. So you'll get a proxy material from your broker probably on the 10th or the 11th. It'll all be electronic. That'd be the soonest you'd get it, is on the 11th. They don't have a meeting location. The record date is the 10th. Record date for voting is the 10th. Beneficial ownership date is the 10th of November. Meeting date is December 17th. And so I assume it's just an annual meeting, like any other annual meeting. And usually those meetings involve voting officers, board members, and maybe other things, but there's nothing I'm aware of other than just a standard course of business to vote on. But like I say, you'll get a proxy package probably by email. It might be mailed to you from your brokerage firm, but probably you're online, you go online, hit a link, and it'll be there. Jason Harbison sold some finger yesterday and wow, good for you. Jason, you were entering the ranks of the wealthy, in my opinion. the wealthy starts at anybody that owns more than one share. All right, let me write it down. But that is awesome, Jason. That's awesome. I love it. You and Donna and Ward and Clay and Steve and there's many others. I'm just not thinking of them. It's just amazing. I'm gonna when this is all over with, I'm gonna be nervous to talk to you guys. You're all gonna be rich. All right. Let's maybe I'll see if I can link to that. It's only 4 o'clock. I don't know that I want to be on much longer, but let's see if I can link to that. Ty Kim. Let's see what he says. Okay, I'm going to read that to you from Ty Kim. At First Adopter, why AI is underhyped and isn't a bubble yet. Here's why AI isn't a bubble today. Just remember, AI, you're talking about lots of different things. And one of the areas they say that is a bubble are the 7, 6, or 5, 4, 5, 6, 7 companies. Yeah, that's different. But anyway, let's just treat it all as one big blob. Here's why AI isn't a bubble today. I've distilled the data points and ideas from my previous columns and coverage. If you prefer facts and evidence-based reality over vibes and conflated narratives, enjoy. So this is from Ty Kim, and it's at First Adopter on Twitter. Big tech valuations are reasonable and leverage is low. There are people that make that argument. So let's keep reading. Big tech valuations are reasonable and leverage is low. We're at the beginning of multiple AI super product cycles in the year ahead. He might mean years ahead. We are in the early innings of a technology computing shift to AI, the largest in decades. Think 1994 versus 1999. That's okay. Every credible source reports overwhelming demand for AI computing capacity. Where is the overcapacity glut? Nowhere. Valuations. During the dot-com bubble, top technology stocks like Microsoft and Cisco traded at 70 to 100 times forward earnings. He says traded at 70 to 100 times forward PE. Well, that is what a PE is. So he's actually saying the PE multiples, it was forward earnings, were 70 to 100 times in December 1999. Remember, these stocks went significantly higher in Q1 2000. I do remember. That's that's another story. Versus today's top stocks, Nvidia trading at 30 times. That's earnings trading at 30 times with materially better underlying fundamental growth prospects. The positive cycle sentiment remains early stages. The Netscape IPO, I had a client always ask for, do you have some shares? Is this the next Netscape? The Netscape IPO occurred in 1995, 5 years before the cycle peak. Is there any doubt the eventual OpenAI IPO will be a Netscape type success? I think she actually used to ask for that tea company. I can't remember the name. I think it began with an N. Is there any doubt the eventual OpenAI IPO will be treated Let me start over. The positive cycle sentiment remains in early stages. The Netscape IPO occurred in 1995, 5 years before the cycle peak. Is there any doubt the eventual OpenAI IPO will be a Netscape type success? AI is only 2 to 3 years in. Think 1994 versus 1999. That's 5 years. That doesn't give me much comfort. The major buyers of AI infrastructure are the most profitable businesses in history, each generating roughly 100 billion in annual net profit. That gives me comfort. This is nothing like the debt-driven fiber optic network build out of the dot-com era. Generational secular computing shift. The global TAM, total annual market. I really never looked up TAM. Is that total addressable market? Total annual market? The global TAM for IT spending is 5 to 6 trillion annually. So that must be total addressable market. The global total addressable market for IT spending is 5 to 6 trillion annually. Lordy, lordy, lordy. What if Railtown got 1% of that? The entire technology stack needs restructuring and re-architecting. That's why English is such a great language. You can totally abuse it and people understand what you're saying. So therefore it becomes a word. Re-architecting for AI, because this new technology produces better results for corporations and consumer. You know, Google has to look out. I think it's Chat GPT or it's OpenAI. They're coming out with an agent that apparently can search better than Google's search engine. That's a little scary. Not going to do it. Kind of scary. You either use it or get disrupted by rivals who do. There you go. You either use it or get disrupted by rivals. That's the arms race. That's the arms race. Think electrification. Think the advent of the microprocessor and personal computer in the early 1980s. It's that significant. That's the trend I missed. That's the trend I missed. The first growth wave was driven by natural language processing with large language models and the application of parallel GPU computing. For the first time, computers could understand context from user language input. Previously, if you typed one character wrong, incorrectly, in a query request, the computer would fail. GPUs allowed companies to apply incredible computing power to distill and compress knowledge from vast pools of unstructured data. The current second wave of growth is driven by reasoning models that are significantly more accurate and useful by spending more time working on requests and searching dozens of websites. Reasoning models use 100 to 1,000 times more compute resources than prior models. Compute. The next wave will feature increased use of multimodal models, audio/video, and agents, workflow automation, multi-step tasks. The following wave will be driven by physical AI, drug discovery, factory simulation, and robotics. Robotics are already here. I understand you can buy a female robot from Japan. It's like $18,000-$20,000, and you can even get a setting on it, and she can nag you, nag. AI bubble skeptic arguments. Skeptics focus on simplistic narratives without nuance. It's up a lot, so it must be a bubble. That sounds like some platinum tigers we know. OpenAI is losing a lot of money. This mirrors narratives from earlier this year when skeptics claimed the DeepSeek moment meant expensive training runs were no longer needed because DeepSeek was trained with only $6 million in spending. A false statement, especially as literally in the same week, China announced $140 billion in new AI investment. They also claimed DeepSeek's efficiency meant a computing glut was ahead. Both views proved categorically false and misleading as reasoning models, including DeepSeek. As reasoning models and better AI models sparked an exponential wave of AI computing demand over the last 9 months. OpenAI's business model divides into two parts. Training new models requires enormous fixed investment, with each model driving roughly 10x more spending. Inference is the other. So OpenAI's business model is two parts: training new models and inference. Inference serving already developed and built models is extremely trying to get my back is extremely profitable. Do you believe leading AI edge models will be a foundational technology transforming every business worldwide? The answer is yes. Companies, how do you know what I'm going to believe? Anyway, the answer is yes. Companies view the risk as existential. That's the key. These business decision makers fundamentally, whether or not AI is profitable, which I would agree with him, it is, but they're all going to decide to do it to keep up with each other. 100% of NVIDIA's engineers use AI coding assistants like Cursor. These AI assistants make engineers more productive by auto-completing code and automatically fixing bugs. All developers will use AI assistants in the future. Customer service, the same. AI will improve chatbots for customer service while giving live agents all the information they need from prior conversations and the latest product updates to improve service quality. Sales agents, same. I wonder how real estate agents are going to be in the future. I wonder how wealth advisors are going to be paid in the future. I wonder how. Anyway, product research and development, SAVE. AI will test product ideas and iterations while simulating every permutation. This is happening and will continue happening. It's inevitable. Every company will use AI in every part of their business. I spoke with executives from NVIDIA, Dell, and Microsoft here this month. It's occurring everywhere and accelerating. Circularity. Thus far, the vast majority of spending has come from profitable large technology companies. Now concerns about circular vendor spend is rising. Despite what you hear, much of this hasn't occurred yet, and each gigawatt of spending depends on specific performance technical milestones on both sides. AMD OpenAI deal, for example. Yes, the Oracle OpenAI deal is real with hundreds of billions in RPO. I don't know what RPO stands for. Revenue, production. I don't know what it stands for. Let's assume it's 300 billion over 5 years, requiring 60 billion annually. It's a lot. RPO. Obligation. Real price obligation? I don't know. Alphabet Google generates about 400 billion in sales with 120 billion in profit. Wow, that's a lot. Meta generates 200 billion in sales with 73 billion in profit. That is a lot of squid. Markets and investors look at potential future, not the present or past. And that's true in real markets. That isn't true in all these other little things that are just overwhelmed by shorts. The question becomes, can OpenAI eventually become a technology giant using their AI model advantage and product execution abilities? ChatGPT's user base has grown from zero, Z, to 800 million in 3 years. That's a lot. That's like the population in China. As a give or take. Can it reach 2 or 3 billion in another 3 years? It seems achievable. Like Google in its early years, ChatGPT currently has a scale advantage where the large user base has started a flywheel, enabling ChatGPT to iterate, improve, get more data, and A and B test better answers for users. Is that a good point? This is well written. The NVIDIA NVL72 supercycle, pre-iPhone moment. Dan Benton noted that technology investing revolves around product cycles. In just over 2 years, NVIDIA, or NVIDIA to the rest of us, has increased its quarterly data center revenue tenfold. Wow. In just over 2 years, NVIDIA has increased its quarterly data center revenue tenfold. As impressive as this is, the company will likely experience its best product cycle over the next few quarters, comparable to the iPhone launch. NVIDIA has recently begun shipping GB200s and the GB300 NVL72 servers in volume for the first time. Foxconn, a major AI server manufacturer for NVIDIA, reports that current quarter AI service revenue will increase 170% year over year. What is the NVL72? Inquiring minds might wonder. I have no idea. The first AI server with 72 GPUs in one server rack versus 8 GPUs in prior models. So it's the first AI server with 72 GPUs in one server rack versus 8 GPUs in one server rack in prior models. It offers 25 to 30 times better performance than the previous model and will enable more AI capabilities and use cases. Each server weighs 1.5 tons. So I guess if 400 tons of highly radioactive water pours into the Pacific Ocean every day from Fukushima Daiichi since March 11th of 2011, because they built it on an underground river, and then they're spraying seawater on the Korea, and it all comes into the sea. So I guess that would be like 250 NVIDIA racks a day being dumped into the Pacific Ocean. Anyway, each server weighs 1.5 tons, contains 5,000 copper cables. Copper might be something to invest in, and offers unprecedented computing density. There, computing is used correctly, finally. Why can't we use the word computing correctly? Why do we have to call it compute power? Why can't we call it computing power? AI demand signs. Every credible industry source reports off the charts demand and overwhelming compute shortages everywhere. Every single one. Microsoft's Scott Guthrie, head of the cloud and AI group at Microsoft and member of the senior executive team, told me this month he sees an explosion of AI infrastructure usage ahead, driven by reasoning, agents, and workflow automation. T.D. Cowen, quote, based on our checks, third quarter 25 would represent the largest inflection in demand we have seen since the inception of the data center industry. A staggering 7.4 gigawatts of U.S. data center capacity was leased by hyperscalers in third quarter 25, which would exceed all capacity leased in 2024. It's the largest inflection in demand in history. Right now, more capacity in one quarter than all of last year. I don't think I talked in those kind of terms of this capacity, the metrics, because I didn't know them, these gigawatts and all that. But remember, guys and girls, in June, this is some of the reasons, but the wind is in our backs. The wind is in our sails and at our backs. And I did talk about data centers and the increase. Anyway, I know it's not about me, but what I'm trying to say is all our dreams are coming true. All our predictions are coming true. TSMC CEO said AI demand is stronger than they thought 3 months ago. Given the strength 3 months ago, that's remarkable. He then literally describes today's growth as insane, strongly hinting at guidance and CapEx raises in January. 4-year-old A100 GPUs remain profitable today on inference tasks. Microsoft AI startup employee states, quote, many days it feels my whole job is begging for GPUs. It's been that way since 2020, and it hasn't become easier, unquote. Anthropic's annual recurring revenue grew from 1 billion to 7 billion in 10 months. See, that's why people are willing to pay 100, 150, 200. That last one I showed you was 250x on revenue, 50 million revenue, because ultimately, when the annual recurring revenue gets to $1 billion a year, it can grow to 7 billion a year. So the company, let's say SoundHound, which has zero revenue, currently valued at 7.5 billion. People must be thinking eventually they're going to be profitable and they'll be spinning off revenue of 1 to 7 billion a year. Who knows? But that's why the multiples are high, because the revenues can grow so dramatically. Revenue in 1 year is equal to valuations early on of the whole company. Crusoe CEO, that's one I showed you. Every single customer we talk to is compute constrained right now. How can we use that word? Every single customer we talk to is constrained by computer power right now. Whatever. It's a word that's here to stay. AI token consumption data points from Microsoft OpenAI and Google show exponential growth year to date. Conclusion. Hold on to your hats. We're just getting started. The next several quarters are going to be off the charts. Written October 25th, 2025, 384,000 views. Written by Ty Kim at First Adopter. And that was pretty impressive. That's pretty impressive. I like that. So it's 5 o'clock. Should I stay on? I guess I'll stay on because it's warm. And I'm too nervous. I want Toronto to win tonight. I got to pick a place to go watch them. That's not too expensive, not too cold, not too boozy. So I've got 3 hours until then. Maybe I'll leave at 7:30. So I guess I got a couple of hours. I could blab on and on. Good job, Jason Harbison. Ward Richardson. Good afternoon, William and the RT crew. Here are some headlines I have read. Tim Cook says Apple is open to mergers and acquisitions on the AI front. No kidding, they're so far behind. Big tech's AI spending is accelerating again. Amazon, Meta, Google, Microsoft tripled down on AI spending. These are key headlines. So let me just go through those words. Let's go to Amazon. Well, anyway, let me first see if there's any news. All right, CBS Sports, World Series game predictions. Yeah, but CBS, they always have another link that you have to pay for. Looks like the betting line is favoring Dodgers. I think that's a mistake. I think all right, this guy, Anderson, precedent favors the Blue Jays. Historically, MLB teams who take a 3-2 edge in a best-of-7 series have then won the series 70% of the time, despite having a losing record in Game 6. Even so, I picked the Dodgers to win the series at the start, and I'd be a fool or a coward to bail now. I do think the Dodgers can piece together 9 innings. Shohei Ohtani, Tyler Glasnow, Blank Snell, and hitters at the top of their lineup looked a lot more like their usual selves in Game 6 than they had previously. He's predicting Dodgers 5, Blue Jays 3. Axia. I picked Toronto to win 7 games before the series, and I see no reason to go against that. The Dodgers still aren't hitting. I agree, they're not really hitting. And they got lucky. That one ball down the first base line, the guy almost caught it. Blue Jays 6, Dodgers 5. Feldman, I was pretty easy to. I think it's going to be a blowout by the Blue Jays tonight. I don't even think it's going to be close. All right, let me go with those, Ward. Amazon, AMZN. Market cap of Amazon, $2.6 trillion. Meta, let's go with Meta. Market cap, 1.6 trillion. Goog, 3.4 trillion. And Microsoft. I think we already know that one. $3.8 trillion. So the lowest one, I think, was Goog. That's probably because ChatGPT is a threat. So let's go with Goog. No, it wasn't Goog. What one was the lowest then? Meta? Maybe it's Meta because Meta's not in this space. And Zuckerberg isn't as smart as everybody thinks. Maybe that's it. All right, yeah, it's Meta. 1.63 trillion. Let's take 1.63 trillion. Take 1% of that. That's 16.3 billion. I know you're thinking I'm just making this up. I am. So what if Meta bought Railtown for 1% of its market cap by issuing Facebook shares? And there's 350 million shares outstanding. I know, I'm dreaming. That's $46 a share. Ward Richardson, NVIDIA steps up South Korea AI push with, I guess that's the 260, with 260,000 chip rollout. These chips are $60,000 to $70,000 a piece. Wow. Wow. It's big, isn't it, Ward? It's big. Oh. All right. Let me go back to the 3 chapters I read to you. I'm not going to reread them, but I just want to go through some of those points to reinforce your ability to learn. And of course, I guess it's kind of my opinion, but chasing short squeezes caused by Wall Street buying in positions, I don't think that used to happen. I just don't think it happens anymore. So the first sentence of the book, what's this book about? It's about the taking of collateral, all of it. Couldn't that describe what the banks and the US military and Europe are trying to do in Russia, Iran, and Venezuela? I would say velocity of money is way down because people aren't spending as much. But it's certainly true. I can't quote anything. It's just things I've read over time. But to my memory, faulty as it is, I don't think an additional dollar spent by the government, for example, is leading even to $1 increase in the GDP. The velocity is down. So there are no property rights to securities held in book entry form in any jurisdiction globally. And that was a big change right around 2010. Might have been 9, might have been 11. The banks no longer allowed you to hold your shares in safekeeping. Everything had to be in book entry, which means it's electronic. You can't prove anything. So here's the other thing. I'm changing the beginning of the sentence. They changed from processing physical stock certificates to book entry, transfers of ownership via computerized entries in a trust company, that's DTC, that would hold the underlying certificates immobilized. You just have one big block of stock in street name, they hold it immobilized. So at the end of the day, Wall Street reckons up and nets it all out. And these hedge funds and trading desks that used to be inside the brokerage firm before Obama, post Obama, they broke the firms in two. So those trading desks and prop desks went out and started hedge funds, and they do the same crap from out there, but now the trading runs through the prime broker. The stock loan desk is, I assume, at the prime broker, but it might be I assume it's at the prime broker, lending endless shares, but they all know each other, and it's a symbiotic relationship, because that's how the prime broker makes it money, from fees on lending stock that doesn't exist and derivatives on stock that your stock that they collateralize and then use over and over and over again in derivatives on a massive scale. That the derivatives market is probably approaching $500 billion. It's 350 trillion to 400 trillion last time I looked, and they base it on collateral, which has not only been hypothecated, it's been rehypothecated and rehypothecated. It's all a bloody house of cards. That's why they need $100 trillion worth of Russia. It's not about Putin is a jerk, he invaded Ukraine. It's been done to all tradable financial instruments globally. But you know where it hasn't been done? Russia, China so far. I don't know about India. I don't know. I don't think so. Certainly not Iran. So if one of those countries, or some combination, maybe using AI, I don't know, but if they could create honest and transparent markets, the sucking sound, you hear that sucking sound? It would be unbelievable. Be like a bathtub draining when you pull the plug. Our markets would disappear. The only thing they can't create is our deep bond market, but that would also disappear. If someone created a honest market, it would all disappear. Then he says, It is now assured that the implosion of the everything bubble that's not what he said. He said, it is now assured that in the implosion of the everything bubble, collateral will be swept up on a vast scale. So first, by going to war, they're going to try to sweep up collateral in the parts of the world that they haven't loaned any money to. Once they get that done, the everything bubble collapses and they take everything. Are they doing that so they can hand it off to the Anunnaki when they return? Are they doing it so they can take it with them when they pass on? Are they doing it for their grandchildren? I don't know. Account providers, that's your brokerage firm, are legally empowered to borrow the DTC, the certificate, the pooled securities, without restriction. There's no restriction. They can borrow it, lend it, so that the clients of Lynn Partners or the clients of Yorkville Advisors or Alpine can just sell stock all day long that doesn't exist, because the brokerage firm can borrow those securities without restriction. He doesn't say it here, but it's also without limit. They can do anything they want. This is called self-help. As we shall see, the objective is to utilize all securities as collateral. Do you see why I say that I think the war is about to happen is all about collateral? All about collateral. And then you guys tell me that when Bitcoin and the other coins, XRP, get into ETFs, that's the place to be. What I see, but I can be wrong, but what I see is the banks are just creating products that people willingly put this brand new collateral. I mean, 15 years ago, none of this collateral existed. Crypto didn't exist, and now it's collateral. But you put it in an ETF, it's in the banking system. And I think the whole part about it, where does this collateral get value? I don't remember the number, but I think the U.S. government debt is at 37 trillion. That's where it is. We've issued 20 trillion since Wolfowitz licked his comb and combed his hair alongside Cheney, Rumsfeld, the new American century, Robert Kagan and his wife, Victoria Nuland. Unbelievable. All right. I don't know what else to talk about. 5:30. We could look back at poolside, but I already did that yesterday. So maybe it's time to turn this off and not bore you guys. Let me just see what's going on in the world. All right, we're not at war, it doesn't look like. which is good, which is very good. And I can't find any headlines that are worth looking at. Unbelievable. On Friday evening, a judge ruled that President Trump is not allowed to make proof of citizenship mandatory for voting. Judge Colleen Constant Collar Cotelli, an 82-year-old Clinton appointee, permanently blocked President Trump from requiring citizen proof on federal voting forms. I'll keep my comments to myself, but she called it unconstitutional. I doubt it says in our Constitution that anybody can vote. What on earth is unconstitutional about requiring American citizens, who are the only people legally allowed to vote in the United States, to show proof of that in order to vote? Exactly. But hey, I'm not going to make my comments that would get me in trouble. Somebody ripped off BlackRock for $500 million. Why couldn't we have done it? Berkshire Hathaway's cash pile hits a record $382 billion. That's a lot of money. I love this. Who wrote it? I can't read that out. I can't read that out, not after the trouble I got in with you guys. All right, I don't know what else to talk about, so I guess I'll leave you. We'll read the rest of that book. You can get a copy yourself, but the main thing, I guess the main reason to focus on The Great Taking by David Rogers Webb is I'd love it if you guys would stop listening to the argument. I mean, if you agree with me that these squeezes are going to happen. I mean, if one does, it's a lightning bolt. But not only is the system set up against you, it's legal for these brokerage firms to just give you a securities entitlement. It's legal. So anyway, I don't want you going back there, but also when these guys come to you when Railtown is up, I can think of two of them who are going to take credit with you that that stock's up because they called it, they were there, blah, blah, blah. And then they'll give you other ideas, but it'll all be these suspicious, manipulated stocks. Some, maybe some get there, but not first without going down. And then they run and they say, see? But it's not always. I mean, for every one that seems to work out, if you traded it properly, there's a dozen to 20 that don't. So it's a real minefield. So I don't want you to think of Railtown as hot money. It's not the same kind of story. And you don't need to get out just because it's up. And I guess the other thing, it's kind of interesting that it is all about collateral. But we'll read, I owe you the prologue and some of the other chapters. It's not long. It's about 100 pages. And we already went through a big part of it. But we can do that maybe tomorrow. I don't know. I don't know my mood tomorrow. And then I don't really have much to say on Railtown, except that it's interesting what Eric pointed out. Probably November 9th. Well, no, it's the 10th is a Monday. So November, let me look. Make sure. Yeah, so November 7th, the stock might start trading up by then, maybe, because that's the X date. Who knows? We'll see for the annual meeting. And I'd like to go to the annual meeting. Maybe some of you guys would be interested. Maybe we can make a event out of it somehow. Otherwise, good luck to the Blue Jays tonight. I wish each of you a pleasant evening. And maybe I'll come on tomorrow, but certainly we'll talk Monday. Cheers. Thanks for signing in.